allow me to read Ms. Lutfiana Larasati, CPA Australia profile. So Ms. Lutfiana Larasati, CPA Australia, she is a Climate Finance Program Manager at the Climate Policy Initiative. She is also a Young Professional Committee, CPA Australia Indonesia. Ms. Lutfiana or Ms. Chika is a Climate Finance Program Manager at the Climate Policy Initiative, an analysis and advisory organization with deep expertise in climate finance and policy. She has more than combined 10 years of professional experience in sustainable investment, risk management, capital market, and due diligence. At CPI, her work primarily focuses on climate finance, innovative blended finance, and the risking instruments, energy, land use policies and mechanism, and regulatory and technical studies in supporting the transitions towards the green economy. Prior to CPI, Ms. Lutfiana worked at investment bank Citigroup, where she evaluated capital markets and underwriting business for emerging economies. Prior to Citigroup, she worked at Ernst & Young Transaction Advisory Services as senior consultant, where her work focused on the financial industry and energy sectors. Highlights of her work include a zero-waste palm oil projects, scenario analysis of the anticipated deal structure of geothermal companies, and due diligence for Indonesia Power Companies IPO. Ms. Lutfiana holds a double master's in business and accounting from Monash University, Australia. She also holds a Bachelor of Business and Commerce in bracket accounting and e-business from Monash University. She is a member of CPA Australia and serves as a Young Professional Committee at CPA Australia Indonesia office. Ms. Lutfiana, the session is yours.
Thank you, Pak Putra. First of all, let me say thank you for the opportunity for CPA Australia, UID, and also ELiabilities for hosting this very insightful session tonight. Panel discussion, the urgent upgrade needed in carbon accounting to drive the green finance revolution. So before we conduct the panel discussion, let me introduce, we have joined here two very we're going to have a very insightful session from the two sources. The first one is Professor Karthik Ramanna. Professor Karthik Ramanna is a professor of business and public policy and director of Master of Public Policy Program, University of Oxford Blavatnik School of Government. Dr. Ramanna is an expert on business government relations, sustainable capitalism, and corporate reporting and auditing. Professor Ramanna studies how organizations and leaders build trust with stakeholders. Previously, Professor Ramanna taught at Harvard Business School in both the MBA and Senior Executive Education program. Professor Ramanna developed E-liability alongside Professor Robert S. Kaplan from Harvard, which won the Harvard Business Review 2022 McKinsey Prize for groundbreaking management thinking, and co-founded the E-liability Institute, a global nonprofit with a mission to rapidly ramp up adoption of e-liability methods and create an ecosystem for rigorous carbon accounting worldwide. And we also have joined here our second speaker, Dr. Adi Budiarso FCPA Australia. Dr. Adi Budiarso is a director for Financial Sector Policy Center, Fiscal Policy Agency, Ministry of Finance of Republic of Indonesia, Chairman of Advisory Committee, CPA Australia Indonesia Office. Dr. Adi has held various executive positions managing cross-functional initiatives at Indonesia Ministry of Finance since 2014. Before his current positions as a director for Financial Sector Policy Center, Dr. Adi served as a head of Center for Climate Change and Multilateral Policy and Sherpa for Ministry of Finance Coalition, of Finance Minister for Climate Action and Deputy MOF for APEC in 2019. Dr. Adi has served head of Finance Profession Supervisory Agency from January until July 2019, and Human Capital Advisor to the Secretary General of Ministry of Finance from November 2018 until January 2019. He has been the Working Secretary for Indonesia Planning Team for 2018 International Monetary Fund World Bank Group annual meetings in Bali. And previously, Dr. Adi served as Chief of Organizational Transformation Officer at Central Transformation Office, where he directed the Human Capital and Digital Transformation Initiative in line with aspirations developed world-class Ministry of Finance in 21st century. So we have here two prominent speakers. The first session will be Professor Karthik Ramanna. He will be highlighting the E-liability approach with us today. So without further ado, Professor Karthik Ramanna, for the next 30 minutes, the floor is yours.
Thank you. Thank you so much for having me here. I'm delighted to be able to join you to speak about the E-liability approach and about the Institute more broadly. Let me say at the outset that, the E-liability Institute has a particularly strong and close connection to Indonesia and to UID Bali for a number of reasons. First, because the very first company in the world to pilot the E-liability approach was GT Tire, which, as you know, is based in Indonesia. And the second is that the E-liability Institute was formally launched in Bali in November of last year at the G20 meetings. And so UID Bali is the home of the E-liability Institute, although we are based incorporated in California, based in London and New York and New Zealand. Our home is very much with our friends in UID Bali. So very, very much delighted to be here with this group today. I will spend a little bit of time walking you through the E-liability approach. I understand that everybody here has a strong background in accounting, financial accounting or management accounting. So hopefully some of the technical details that I share with you will be of great interest, because the E-liability approach draws on a strong accounting background. And we will also maybe share with you, if time permits, some of the various lessons that we are learning from pilots that we have, pilots of the E-liability approach that we have conducted over the world, including GT Tire, but also many other pilots in other parts of the world, like Europe, the US, India, etc. So I'm assuming that I can share my slides. So what I'm going to do is just give me 1 second while I figure out how to do that. There we go. So can people see my slides now? Yes. Okay, excellent. So let me just restore the so that I can see people as well. It's for those of you who have a strong bandwidth, do keep your videos open so that I can see people as I talk you through this, because otherwise I'm just talking to my slides. So, but very good to see some familiar faces. Andre is there in the audience. Hello, Andre.
Hi, Professor Ramanna.
And very good to see so many familiar faces. There we go. Oh gosh, what did this do? Sorry, give me 1 second. Okay, so can you still see my slides?
Yes,
or
Professor.
not?
Yes.
You can. Okay.
We can.
Okay,
We're
excellent.
seeing your presenter's note.
Oh, you're seeing the presenter's notes. Yeah, I don't know why it's doing that.
This one better.
Can you try the presentation mode, Professor?
So
Right.
so I got.
Yeah.
So
the current
presenter view.
or the current slide.
No. This
Perhaps you try the play from the current slide. Yep, that's the one, Professor.
play from
Yep.
start.
Yep. Oh, the same thing as well. Okay.
Yeah, I don't know why it's
Yeah.
never done that before. But
Maybe you can go to the bottom. Go to the
sorry.
button. Go to the button, Professor, and there's a button there, slideshow.
Yeah, slide here. Slide play from this one. Play from slide. Play from start.
Can you go down? There's a button, the small button.
Here. Slideshow.
left-hand side at the bottom.
Oh, yeah, you can swap the display if you slideshow again.
Yeah.
Where we were, there's a button for swapping. So on the upper right, upper left hand, there's a swap displays.
Oh,
Swap
swap display.
display.
Okay.
Yeah, there we go.
Yeah.
There we go.
Okay.
Oh, okay. Okay. Excellent. Okay. Thank you. Okay. See, you guys are so much better at the technology than I am. Okay. Very good. So you can now see my slides. I'm hoping. So let me walk you through some of the, and I can't see the chat. I don't know if there are questions in the chat, but if there are comments or questions in the chat that are relevant, someone can just alert me to them because I can't otherwise see them. Now let me try and move. Okay, so let me start off by saying, what is the problem we are trying to solve? And the problem is a very specific but managerially relevant problem, which is, how can an organization identify specific actions to decarbonize its outputs, and how can it differentiate those outputs from others once it has engaged in that decarbonization? So that's sort of the first and most important question that we're after. And the second, maybe related question, you can see this first question from the supply side of things. The second question you can see from the demand side of things, which is, how can financiers, whether they are development bankers, whether they are financial advisors, whether they are asset managers, whether they are asset owners, all kinds of financiers, how can they identify specific low carbon investment opportunities and hold their investees to account on these decarbonization targets? So those are the two most important. They're the same question in some sense, but you can see one question, the first question, is written from the supply side, which is from the perspective of companies, thinking about how do we identify specific decarbonization actions, and how do we differentiate our outputs on the basis of our successes in that field. And the same question asked from the side of the financiers is to say, how do you identify specific low carbon investment opportunities and hold those investees to account on decarbonization? Now, you'll notice that in both of these questions, I have italicized the word specific, because that's what's key to understanding the E-liability approach. So what I mean by specific is that it is the emissions that are unique to a given product or service. That is to say that the cost associated with producing this iPhone is different from the cost associated with producing the iPhone that is probably sitting in your pocket. And that's because they were made in different batches. They were made probably in different countries. They were made at different times. And so those cost patterns change. And so in order to be able to use accounting as a tool to drive strategy, these costs have to be tracked down to specific products and services. In the same sense, if you want to use carbon accounting to drive strategy, the emissions profile associated with any product or service, or indeed with a whole company, need to be specific to that particular setting. So in that point of time, for that particular product. And what that means is that for the vast majority of the calculations, you have to use primary data. You have to use supplier-specific data. You have to use data that is original to that particular product or service, rather than using, say, emission factors or industry average factors or regional factors that might be used in current carbon disclosure approaches. So there are obviously existing carbon measurement approaches like the product level LCA approach or the company level scope 3 approach. But these are highly approximate approaches because they use emissions factors either at the industry level or at the regional or geographical level. And so what has come to be known as secondary data. And so as a result of using these secondary data, they are both approximate methods, but importantly, they're prone to making errors and to manipulation. So they cannot be used for the purposes of strategic decisions. Strategic decisions both on the side of the company that is trying to decarbonize and on the part of the investor that's trying to identify the lowest carbon investment opportunity available in the marketplace. So that's the importance. And it's important to see this as a strategy problem rather than to see this as an accounting problem, because you might solve this differently if you see it as strategy versus accounting. And the e-liability approach is all about strategy first. Okay, so let me give you an example of this, right? Earlier I held up the iPhone, but let's take a slightly more, slightly simpler example, because making this iPhone is very, very complex. Let's say for a moment that I'm trying to calculate the emissions associated in manufacturing a car door. So you've got on the screen a car door in the center, and I'm trying to calculate the specific emissions in manufacturing the car door. Now, that car door is composed of many, many components, right? So the car door is made of steel, but it also includes some plastic, it includes some glass, it includes some electronics. It might even include some wood trim and so forth. And you can imagine that each one of those inputs, whether it's steel, glass, plastics, electronics, wood, are in turn made through very complex supply chains, right? And so if I were sitting in that car door manufacturer and trying to calculate what are the emissions associated with making that car door, then what I would have to do is first understand who all my suppliers are, and then understand who their suppliers are, and so forth, until I can get a sense of what are the emissions associated in all of the inputs I'm using. And then I'm going to have to figure out what are the emissions created in the context of the direct manufacture of this car door, which is to say that in assembling the car door in my factory, I will have to use some electricity. I will have to use some, maybe I will be sort of involved in, burning some fossil fuels on site to produce heat for the factory. I might have to think about, what is the emissions associated with all of the employees that commute to my factory. I might have to think about all of the emissions associated with, the overheads associated with running the corporate head office for this factory, and so forth. So there are all of these questions that I have to get at if I'm trying to calculate the emissions with this car door. And to an extent, the Scope 3 approach, as well as the life cycle analysis approach, tackle some of these challenges, right? So they are trying to get at this question. And they get at this question by recognizing that this is such an informationally complex problem that it's better to just use some emission factors. So you say, okay, well, most car door companies will know, obviously, who their direct suppliers are. They'll know who their steel supplier is, who their glass suppliers, who their plastic suppliers, et cetera. They'll know who their electricity suppliers, but they won't know who their suppliers are. They won't know who their suppliers are, and so forth. So the approach in practice says, well, if you don't know these things, you can basically calculate or use sort of emission industry factors or regional factors that you can substitute in this and create some approximate measure of the emissions associated with that car door. Likewise, if you were doing a life cycle analysis of this car door, you would sort of do something at the level of the product, and then you would be sort of also looking at what are the downstream impacts of the emissions for this car door. So, for instance, what are the emissions associated with manufacturing the car in which this car door is part of? You'd be looking at what are the emissions associated with the distribution of that car to the showroom, and then what are the life cycle usage emissions associated with the car as well. So these are all the sort of estimates that you'd have to calculate. Now, if you think about this process, it's a highly informationally complex process. It's a process that involves multiple counting of the same emissions at various stages of the way. It's a process that involves, in some sense, a level of redundancy, because if I'm the car door company doing this, I would have to go through this whole process. But so would, say, the car manufacturer, so would the steel manufacturer, so would the mining company at the beginning of this value chain. Everybody's doing the same process, and everybody's using all of these industry emissions factors. And by the time you do this process each time, the data are already outdated. So if you were doing a life cycle analysis of a car door, you at most produce these LCA analysis maybe once every 2, 3, sometimes every 5 years with companies in the steel sector. They are required to produce it every 3 to 5 years. So the data become highly outdated by the time that you're actually using. So again, remember, if the question is, how do I use this data for strategy, then this is really a very hard approach. This is a very untimely approach. And it's a very approximate approach, which is why people are concerned that it lends itself to manipulation, it lends itself to gaming, and it might be used for some external disclosures. These approaches might be used for some compliance purposes and external disclosure purposes, but they can't be used for resource allocation decisions. They can't be used for decisions involving corporate strategy. And that's the problem that we want to solve. So imagine that you wanted to solve this problem in a real-time, accurate way, so that the emissions that you are calculating for any car door in this value chain are the emissions specific to that car door at that batch level, right? And you want to be able to do that on a continuous basis in a real-time way that's accurate. Then how would you go about doing that? That's what the E-liability algorithm is really trying to get at. And the process, you can think of it as sort of starting from the very beginning of that value chain. So let's say for a moment that you're making that car door, and one of the ingredients in that car door is the steel, and one of the ingredients in making the steel is iron ore and metallurgical coal. So let's go back to the mine where the iron ore and the metallurgical coal are being mined. And let's say that on a given day, somewhere, in the month of August of 2022, we've got 1 ton of metallurgical coal and 1 ton of iron ore being mined in this mine here. And that 1 ton of coal and 1 ton of iron ore is associated with 1 ton of CO2, respectively. So you've got 2 tons of CO2 that have been emitted associated with that those 2 minerals. Then as those minerals get transported to the steel mill, so here you see a shipping barge that is transporting these minerals to this steel mill, there are some emissions associated with the actual transportation of that those minerals, the actual emissions associated with that barge as well. So then those emissions get added into the emissions associated with the ore itself. And then as you're making that, turning that ore into sheet steel, then there's obviously a chemical reaction that's involved in converting iron ore and coal into sheet steel. That chemical reaction emits CO2, but you need a tremendous amount of heat energy in that process, tremendous amount of electrical energy, and maybe you're burning additional fossil fuels to create that electrical and heat energy. That's creating its own emissions. So those emissions then get added into the product calculation for that sheet steel. Then that sheet steel gets allocated or transported to the car door factory. And then there are some emissions associated with the transport of that sheet steel to that car door factory. Those have to get added into this process as well. So by the time I'm acquiring the sheet steel at the factory, the car door factory, the process has started to calculate the total emissions associated with making that 1 unit of sheet steel. And then as I bend that 1 unit of sheet steel into a car door and assemble that car door, then I calculate how much of that sheet steel have I actually used in that car door so that I can apportion that amount of the emissions to that car door. If this process is starting to feel familiar to those of you who are cost accountants, then it absolutely should, because the process is very, very much similar to how cost accounting calculates the cost associated with any inventory anywhere in the system, right? So basically what the E-liability algorithm does is use that value-added approach or a VAT type system approach to calculating the emissions for any product or service in the economy. So for those of you who are accountants, you're familiar with these T accounts. And what these are T accounts that apply to E-liabilities. So what is an E-liability? An E-liability is basically a liability that you create with Mother Nature when you emit a unit of CO2 into the atmosphere. So E stands for environmental. So when you emit a unit of CO2 into the atmosphere, you create an environmental liability with nature. That is an E-liability. And what you are doing is, as you are creating that E-liability with nature, you are recognizing that as a liability on your E-accounting books, your environmental accounting books. And as you buy more services, you take in the E-liability associated with those services onto your books. As you buy more products, you take in the E-liabilities associated with those products onto your books. And as you sell your services and products, you transfer those E-liabilities out of your books onto the books of your customers. So it works just like inventory accounting, but instead of in inventory accounting, you're moving assets as assets, the supplier's assets become your assets as you move the assets onto your books, and your assets become your customer's assets as you sell, make the sale. Here, you're doing the same transaction, but you're doing them with liabilities, because this is the environmental liability that's coordinating with or associated with that asset. So when you as a company are selling 1 unit of your output, whether say it's 1 unit of sheet steel to your customer, in this case, the car door manufacturer, then that transaction basically triggers 2 accounting events. The first is the traditional inventory accounting event that all of you CPAs are already familiar with, which is I will credit the inventory on my books, and I will have my customer debit the inventory on their books. But there is a corresponding E-liability transaction where I will now debit the liability on my books, and my customer will credit the liability on their books. So the liability increases on their books because and that's how it's working, like a simple value-added system. Now, in order to do this, you need an equivalent of cost accounting at the level of entities. And why do you need to do that? It's because you will have emissions that are incurred by entities that will be shared across a number of different outputs. That's why we have cost accounting, right? We have cost accounting because we have shared costs, we have shared resources that have to be allocated across multiple products, right? You think about the car door is using things like sheet steel and plastic and glass, and we said, so as we are allocating units of sheet steel and plastic and glass to a specific car door, we have to count the number of the units of that raw material that go into that car door, and the proportionate amount of those emissions will have to go into that output of the car door. But there will also be some emissions associated with the production process, right? So there'll be the forging process of bending the sheet steel into the car door, and that's going to take some energy. And I'm going to say how much of that proportionate energy being consumed at the factory has to be allocated to a single car door. That will require some cost accounting calculation as well. Similarly, I said earlier, there will be some emissions associated with the overheads, like the accounting department, the billing department, the marketing and sales department of the CEO's department of the company. Those emissions need to get allocated to the products as well. That's going to require an allocation formula as well. So if the E-liability algorithm works on transferring the emissions associated with products as products move through the economy, then you need to be able to calculate the emissions at the product level. And to calculate the emissions at the product level, you need an analogy to cost accounting, which is what is represented in this diagram. So in this diagram is a simplified analysis of basically a company that has 2 products, finished goods A and finished goods B. And these 2 products basically use 2 raw materials, raw material 1 and raw material 2, and a shared production process. And each one of these raw materials basically have 2 greenhouse gases. Red is CO2 and purple is methane, CH4. And the production process similarly uses CO2 and methane, and raw material 2 similarly uses CO2 and methane. And so then as I'm trying to calculate the product level CO2 of the 2 outputs that I've created, finished goods A and finished goods B, I have to say how much of raw material 1 am I using in finished goods A, how much of raw material 1 am I using in finished goods B, similarly, how much of raw material 2 am I using in each of these 2 finished goods, and how much of the production process am I using in each of these 2 finished goods. And based on those proportionate formulas, I can calculate what is the total emissions of this finished good A and what is the total emissions of this finished goods B, right? And that's the simple cost accounting. This is a simple case of basically a company that has 2 inputs, 2 outputs, 2 gases, and a shared production process. But if you can do this for a company with 2 inputs, 2 outputs, 2 gases, and a shared production process, you can do it for a company with hundreds of inputs and hundreds of outputs. Earlier this morning, I was on a call with Tata Steel. They, of course, make many, many different types of steel. They have many hundreds of different inputs, and they can have very sophisticated cost accounting formula that basically do the same thing with emissions as they do with costs. So this is just to show you how it would work in the context of a simplified example. Okay, the advantage of this approach is that once you start doing this, you can create enterprise level reports for any company of the total emissions under management, of the total emissions that have flowed through and have been accumulated in that company. And the way you do that is to add up effectively the emissions across all of the products of that company, right? So rather than take the greenhouse gas protocol's top-down scope 3 approach, where you start from the enterprise level and try to figure out what are the emissions across all of the across the whole enterprise, in fact, here you start from the individual products and bottom up. You add up from the bottom and you say, what are the total emissions across the whole enterprise based on the emissions of all of its individual products? And you can report this very much like an inventory footnote. So those of you who are financial accountants in the audience, you'll have seen an inventory footnote. And the inventory footnote will start with an opening balance, end with a closing balance, and look at the flows associated with inventory over a period. This enterprise reporting for an e-liability looks just like that, but instead of measuring dollars, cents, euros, it's measuring tons of CO2 or kilograms of CH4, whatever it is. It will measure it in the units of greenhouse gas emissions. So for this company, which is a car door company, you've got an opening balance of e-liabilities of 3,600 tons of CO2. You've added in from directly produced operations another 2,600 tons of CO2. This would be the emissions associated with running the forging and bending equipment that's used to make the car doors. And then you'd add the e-liabilities acquired from all suppliers. This would include electricity, sheet steel, glass, plastics, other equipment, plus any capital equipment that you've acquired over the course of that period. Now, what you will do is as you transfer the emissions to your customers, you will subtract the associated e-liabilities with that. And that will include some proportion of the depreciated capital equipment. So not all of the emissions associated with the capital equipment will be transferred to your customers in the same period, because of course the capital equipment will be yielding benefits across multiple periods. So you will depreciate it and only allocate some portion of the emissions associated with that capital equipment. And that will give you basically your closing e-liability balance, and that the difference between the opening and the closing will give you the net change in the e-liability, whether it's increasing or decreasing. Now, those of you who are auditors in the group will know immediately when you look at this, say, I can audit this statement just like I can audit an inventory footnote. I have to audit this closing balance. So what I will do is, I know from last year's audit what is the opening balance. I can look at the receipts and I can therefore calculate what are the e-liabilities associated from suppliers. I can look at the customer sales and calculate, therefore, what are the e-liabilities transferred to customers. And I have to look at what are the direct emissions generated in the company to get this line item here of 2,600. And from that, I can do the math and I can verify whether this closing e-liability balances. So just like if you've run an inventory footnote audit, you know how to run an audit associated already. You've learned in practice, in theory, how to run an audit associated with an inventory. The advantage of this approach is that you report both stocks and flows of e-liability. So you can hold and depreciate GHG emissions from fixed assets across their multiple periods of use. This is really important for things like steel, because you build a steel factory with a useful life of, say, 20 years or 50 years. You buy an airplane with a useful life of 20 years or 30 years. Then the emissions associated with that can be depreciated over that useful life. Again, this looks very familiar, just like the previous slide on the cost accounting looks very familiar to those of you who are cost accountants. This slide should look very familiar to those of you who are financial accountants. Now, what are the benefits of doing it this way, right? What are the benefits of calculating the liability this way? The most important benefit is that it generates an accurate and real-time emission for any product or service, whether it's, say, this iPhone, whether it's this thermos flask, whether it's that car door, whether it's this Zoom call that we're on, any product or service, the same algorithm can be used to calculate real-time product-specific emissions. And it can be therefore used by managers to decarbonize their purchasing, product design, and production decisions. So this is not accounting for accounting's sake, it is accounting for decision-making. Because if I'm the production manager of the car door, and I can see in real time what are the costs associated with all of the inputs that are coming in on my ERP system, but also what are the emissions associated with those inputs, I can make better purchasing decisions. So now, in addition to looking at cost, quality, and timeliness, I can look at emissions as well, right? That can be one more column in my ERP system. And that can then help me think about, well, what time of the day is better to, based on the emissions profile of, say, energy usage, what time of the day is better to use the high emissions activities in the factory? Or which batch of steel should I be buying? Should I be buying from supplier A or should I be buying from supplier B? When I add in the dimensions of cost, timeliness, and quality, I add in a fourth dimension associated with emissions. So it can be helped because it's real time and it's accurate. It can lead to decarbonization decisions by production managers in the moment. The approach is also automatically designed to eliminate or reduce incentives for gaming and manipulation, right? So firstly, a company cannot reduce its emissions by outsourcing production to a third party. Because even if you outsource production to a third party, as soon as you transfer the inventory from the outsourced production back onto your books, the emissions come back on your books. So it doesn't matter if you're outsourcing or not. Once the inventory comes through your books, the emission comes into your books. So this takes away a huge incentive for manipulation currently seen in the Scope 3 framework. The second big advantage of this is that you cannot understate your e-liabilities transferred to your customer, because if you try to do that, then if you go back to this previous slide, then your closing e-liability balance would shoot up, right? So, because if you try to understate the e-liabilities that you subtracted to your customers, this balance would get higher and higher and higher. And the analysts looking at your company, just like if they looked at your inventories and saw that your payables were rising quicker than your receivables and compromising your cash position, they would call you out in the same way your analysts can call you out if you're not transferring emissions to your customers at the appropriate level. Your auditors also can call you out because they can compare it to the average performance of the industry to see whether there are trends that are out of whack. The company also can't benefit from overstating the emissions it transfers to the customers, because then the customer is the one sitting with the emissions on their inventory balance sheet, right? On their e-liability balance sheet. So they're going to say, well, I only want what is appropriate. Either you do it better than the industry or you do it at the industry average. I'm not going to take more than the industry average, because then I'm going to look bad as the customer. So all of those incentives for gaming get managed away in this system because it's what we as economists call incentive compatible. And if you use a system like this, then basically not only does it help internal managers in the company make better decisions on product design, it helps external stakeholders like investors, like creditors, etc., compare entire companies, right? So this can be audited just like financial statements are audited in a true and fair sense in what's called a reasonable full scope audit. And it can therefore be used to verifiably compare companies, resulting in better investment and accountability decisions. If you think about it currently, if a company is basically making a claim to be net zero, then right now, that a claim actually means nothing, because it would be like the CFO of a company saying that my profits in the year 2050 will be 20 kajillion chinchillas. And you say, well, what is a kajillion and what is a chinchilla? That makes no sense. And the same way, like a net zero claim without something like this, which is an underlying accounting and audited system, will not make any sense. But now when a company makes that kind of claim, you can say, okay, I can track that from year on year. I have to see basically that e-liability balance going down, right? So that's the beauty of the accounting system. And it can really hold companies effective. It can drive capital to companies that are effectively running lower e-liability operations than their peers. And it can spur that kind of innovation. So that's what we want to see happen with this approach. Okay, how are we doing on time? So in the interest of time, what I'm going to do is skip over these next two slides and tell you a little bit about the E-Liability Institute. So you've got sort of hopefully now a general sense of the E-Liability approach. And as was mentioned earlier, we wrote this original paper on E-Liability in 2021. And in 2022, we established in Bali the E-Liability Institute. And the idea of the E-Liability Institute was to help to drive this algorithm, this approach into practice. And Mike Mahoney, I think Mike is on this call, joined the E-Liability Institute as our CEO to help basically lead the implementation of this into practice. Oh, there's Mike. Mike, if you can just unmute for a moment and say hello so that everyone can see you.
Good evening, everyone. Thank you so much for this opportunity to have Professor Karthik Ramanna with you today.
Excellent. Now, Mike's the most important person here on this call, because if you're interested in following up with an e-liability pilot, which I'll talk about in a moment, then Mike's the guy that you want to reach out to. Okay, so now what do we do at the E-Liability Institute? We basically do three things. The first is to recruit early adopters to pilot the e-liability implementation. And right now, Mike has about 50 different companies or engagements in consultation, in consideration. And as you know, the first company in the world to do this was GT Tire, based in Indonesia. But now, in fact, GT's plant in China is running this as well. But also we have pilots across the world. And Mike and his team help these companies actually run these pilots so that they can build new insights. Now, we want to go beyond the pilots to actually thinking about how this scales to the whole enterprise. So GT started by thinking about this for a standard passenger car tire in one factory in Indonesia. But now GT's customers, like big car companies in Germany, are getting very interested in this approach. And so GT needs to think about this from a system-wide, from an enterprise-wide perspective. And GT's customer, the car company, needs to think about it not just from the perspective of this one tire supplier, but from the perspective of all its 15,000 suppliers. So part of what Mike and his team do is also supporting the transition from individual pilots to this sort of transition to enterprise and system-wide thinking. And that means working with large enterprise software providers like SAP, like IBM, the big assurance companies, the audit firms like EY, PwC, Deloitte, et cetera, who will be instrumental in making this work at scale. And then the third and final most important thing is to create basically global adoption of the e-liability approach as the gold standard for decarbonization. Again, if you're thinking about decarbonization as a strategy, then you need a strategic information tool, which is what e-liability is. It's real-time information for financing decisions, for investment decisions, green finance, as the title of this session says, but it's also real-time information for individual managers inside companies to make decarbonization decisions. So that's what the E-Liability Institute is doing. In the Institute, as I said, was established in November 2022. So we are in August, so we're about 10 months old now. And in less than those 12 months, therefore in about 10 months, the Institute has made really impressive progress. This is just a list of some of the companies that are in various stages of running e-liability pilots, some of the sample software and assurance intermediaries that are involved in this process as well. And this is just to give you a sense of this. I'll give you an idea of what one of these pilots might look like. So a few months ago, we were approached by Hitachi, which is here on this list, to think about basically a pilot. And one of the things that Hitachi was interested in is in making electric transformers which are needed basically for electric generators, regardless of the fuel source, whether you're using fossil fuels or whether you're using solar or wind or whatever it might be, you need an electric transformer. Whether we should be using in those electric transformers recycled copper or virgin copper. Recycled sounds good because it's, people say, oh, recycled is good, etc. But Hitachi's own engineers were worried that it may be that in some cases, recycled puts more CO2 into the atmosphere, because to make recycled copper, you have to incinerate plastic circuit boards from old computers. And when you incinerate those circuit boards, it emits lots of CO2 into the atmosphere. So what we did with them was build out a pilot that allowed them to count the total CO2 across recycled and virgin copper. And the answer is it depends. There are some processes in which you make virgin copper that are vastly more efficient from an emissions perspective. So put out vastly fewer molecules of CO2 than, say, the recycled copper. So as a manager inside Hitachi making this decision, you now have better data so that you can make transformers that have a lower CO2 input, footprint. And that's really useful information to save the planet. That's the kind of information these pilots are aimed at and are looking to support. So it's accounting for decarbonization and accounting for decarbonization by driving immediate real-time strategy. Now, I have summarized a lot of fairly technical information fairly quickly. So for those of you who are interested in further reading, here's a list of some papers that you can go and look at. So you can just take a screenshot of this screen and then, Google these. These are all available in the public domain. So that is available for you to see. And with that, perhaps I will end my slide share. And if I can figure out how to do that, stop share. There we go. Okay, excellent. Everyone is back. Hello, everyone. And turn it back over to the team.
Thank you, Professor Karthik, for your presentation. Maybe just a bit of review and highlight what is e-liability. Maybe some of the attendees here wondering, what is E? E is actually environmental liability, right, Professor? So this is actually the initiative that's been supporting not only the Indonesian company, but also the global initiative developed by Professor Karthik and also during his time at Harvard. Now, without further ado, let us move to our second speaker. We have Dr. Adi Budiarso FCPA, Director for Financial Sector Policy Center, Fiscal Policy Agency, Ministry of Finance. Over to you, Pak Adi. For the next 30 minutes, we will be hearing the insights from Pak Adi of the regulatory landscape and also the policy landscape of the carbon accounting and also the sustainable finance in Indonesia. Over to you, Pak. The floor is yours.
Thank you so much, Mbak Lutfi. And this quite delighted to have all of you. Thank you so much for Professor Karthik that's been already introduced the new initiatives that we call it E-liability. There is names that we will try to also comprehend today. I believe that there will be interesting topics to be discussed later on. First of all, good evening, ladies and gentlemen. I think we are gathered here on the CPA Australia webinar on the urgent upgrade needed in carbon accounting to drive green finance revolution. The E-liability approach is one of the series. There are many approaches that emphasize the urgent need for standardization. I think that's the one that we would like to also explore in our today's webinar. And this webinar is really provide us with valuable opportunity to gain updates on the progress of the discussion on carbon accounting in line with the energy transition program, especially in the ASEAN region. I just followed the finance minister and central bank governors meeting today. One of the opportunity for us is launching the sustainable finance taxonomy for ASEAN, the version 2. I think that will also improve our vocabulary in terms of the regulation, that will covers the sustainable activities in the business, also in the society. And my presentation today will allow us to assess the extent of our progress in moving towards to a low carbon economy. Furthermore, it serves as a clear signal to global community of the unwavering commitment of Indonesia, ASEAN, and global countries towards the successful implementation of energy transition. So my presentation will explore about Indonesian cases in promoting sustainable finance, which will cover three main topics. So if allow me to ask my team, Bu Aida, if you go to the topic. So there are three main topics. First is on Indonesia climate target, and the second is on Indonesia sustainable finance policies, and lastly, I will cover towards carbon accounting in Indonesia. In these slides, we can see clearly that the climate change is believed to increase the risk for hydrometeorological disasters, which make up to 80% of disaster occurrences in Indonesia, such as we know already flooding, forest and land fire, drought, landslide, and recently in Jakarta we have air pollution, etc. Next slide. The enhanced NDC, I think Indonesia currently committed, next slide, to more ambitious commitment to climate change. As an emerging market and developing country, Indonesia takes a crucial leadership in green transition towards low carbon economy. Last year, Indonesia submitted an enhanced NDC to the UNFCCC Secretariat with the increased emission reduction target to 31.89 unconditionally and 43.20% conditionally. So this enhanced NDC represents greater ambition compared with the previous Indonesia updated NDC, which will align with the long-term low carbon and climate resilient strategy 2050, with a vision to achieve net zero emissions by 2060 or sooner. I think this will be important since when we regard with the EU taxonomy, now Indonesia have also commitment to support ASEAN taxonomy. The commitment is to achieve net zero emission by 2060 or sooner. In the next slide, Indonesia realized that huge financing is needed to implement climate action to support this ambitious climate target commitment. Based on the third biennial update report, BUR 3, total climate financing needs to achieve the previous NDC are approximately 281 billion by 2030. It was projected to be fulfilled by public and private investments. I am underline Professor Karthik, the investment from private is really important. Which this is the increased ambition that surely more finance is needed. So in this regard, Indonesia continues to develop many initiatives, including climate budget tagging in the government side, investment and government disbursement. Government also provide fiscal incentives, government release green bond, green sukuk, and SDG bonds, for example, and also carbon pricing model. The Indonesian government has also transforming the state budget into greener by utilizing public funds to support climate change related projects. Cumulative climate expenditure from the national government until 2021 reaching almost $20 billion, contribute around 8% of the BUR. On the next slide, there are still bottleneck of supply and demand sides. In order to address some bottlenecks of supply and demand sides between financial institutions and the expected green project, Indonesia is open for transition and green business. Transition and green investment are flourishing now currently in Indonesia. This due to, among others, the government of Indonesia has issued a number of fiscal incentives to attract private investment in green project and green industry, including tax holiday, tax allowances, as well as facilities on VAT, import duty, and property tax. These policies have fruitfully cultivated in climate and transitional investment and green investment in Indonesia, notably within the electric vehicle supply chain, for example. For instance, according to ISR research, during 2021 to 2022, Indonesia managed to attract investment accounting for $20.3 billion in the electric vehicle supply chain. The largest share of this investment was directed towards battery production, reaching total $15 billion. Fiscal incentives and downstreaming policy in green industry are expected to curb carbon emission by about 15 million tons of CO2. We also mobilized funds through innovative financing, such as issuing green suku, as I already mentioned before, and also issued the regulation framework to implement carbon pricing and tax in Indonesia. I would like to also now move to the part 2, which is I will try to explore a bit on the sustainable finance policies. In this slide, based on the climate budget tagging, for example, data 2016 to 2021, said budget only covers 20 to 27% of funding needed to contribute to commit our NDC target. And there is still a funding gap around 40% to 55%, which must be increased from other sources. The key challenges here, the government has the ETM program, the ETM country platform, GETP, Just Energy Transition Partnership, and this key challenge is not only involvement of the public, of the government, but also the private sector, where there are still no strong engagement thus far. In considering the risk assessment, we realized that the portion of the low-cost financing from concessional flow of the fund is really crucial in determining the project return. The lower concessional pricing country platform can obtain the more flexibility the country can develop a mechanism to ensure acceptable credit risk. And just transition for investors, lenders, and related stakeholders can committed to support this engagement. Next slide. From these slides, we can explore further about sustainable finance in the financial sector Omnibus law. So Indonesia just released the Omnibus law in financial sector just this year, early this year, in the law number 4 year 2023. There are 3 key strategic initiatives promoted by the this government regulation. First is on encouraging actors in financial sector, issuers, to implement sustainable finance. The second is strengthening the support from the government and authorities in developing sustainable finance, particularly in issuing government regulation on sustainable finance taxonomy. And the third is strengthening stakeholders' cooperation, developing sustainable finance by the development of the Committee on Sustainable Finance Indonesia, organized by MOF, Minister of Finance, PI, and OJK. With this regard, Indonesia current regulation is quite in line with the global standard, with the global practice currently. When we would like to see on these slides, this is the transition initiatives, or we call it ETM. The carbon pricing. Indonesia is proud to be among committed countries in the energy transitions. Collaborated with ADB, the government of Indonesia launched the energy transition mechanism. During COP26 at Glasgow, aiming to accelerate retirement of repurposing coal-fired power plants and scale up the replacement clean energy technology. In this slides, next slides. Yeah, this one. The Indonesia continues to make progress on ETM country platform through the international partnership commitments. The Governing Board of the Climate Investment Funds, GIF, one of the world's largest multilateral funds for climate actions in developing countries, recently approved 500 million of highly concessional funds to Indonesia, which will be leveraged up to 4 billion USD from the World Bank, ADB, and from this approved amount, the priority will be focused on the accelerated early retirement of the second project with total retirement of 1.71 gigawatts of coal-fired power plant. On the next slide, we will try to also use the way Indonesia further established the Just Energy Transition Partnership, or GETP, with a commitment of $10 billion in public sector pledges for the International Partners Group, the IPG, member countries, and $10 billion from private financial institutions. With international support, Indonesia will work to achieve significant targets and policies to reduce greenhouse gas emission and support impacted communities. GTP is a crucial initiative that marks the significant step towards a just and sustainable energy transition. We also launched the Indonesia GTP Secretariat supported by ADB on February 2023 to facilitate and coordinate technical work on this partnership. This commitment should have a comprehensive investment plan to actually realize into real projects. With many initiatives that I have mentioned before, we realize that the more efforts still needed to be done to reach the financing need to commit our NDC, to give actual contribution to reduce global greenhouse emissions, while also keeping the pace, growth, and development. In this regard, I believe that the key achieving growth-friendly climate action lays on transition finance. This is because transition finance involves providing financial services and products to high carbon emitting industries to support the transition towards decarbonization. Therefore, G20 under Indonesia Presidency last year commenced the transition finance framework as guidelines for the development of policies and financial services to support climate-related transition activities. Indonesia also launched the continued development of the ETM country platform as example of how we pursue the financing for transition in energy sector in Indonesia. Next slide. I would like to also explore a bit that government intervention through green investment bank or green investment like entities is required to promote green economy, especially as its early stage of development. The existence of a green investment bank is substantial, attracting private investment, thus shifting from the government-led to market-driven approach. Indonesia doesn't have green investment bank yet, but we have a green investment bank like, which is done by PT-SMI, PT Sarana Multi Infrastructure, and Indonesia Environment Fund, or BPDLH. So the green sustainable projects are still perceived more costly currently and risky than conventional projects. But private sector may seem this to be unattractive for investment. Therefore, this type of projects need government intervention. So many of the developing countries, financial market is not yet well equipped with the capacity to effectively assess the cost risk associated with the green project. In this case, the government through GIB or Green Investment Bank-like entities should lead the process to stimulate this investment. In the next slide, let's now talk about towards carbon accounting in Indonesia. We have three terms that I would like to a bit explore on this area. First is on the government regulation or the regulations that currently happen in this supporting sustainable finance activities, which is, we know exactly about EU taxonomy. I just lastly announced also the ASEAN taxonomy. We know also the ISSB, International Sustainable Standard Boards. We have corporate sustainability reporting directives, etc. There are several regulations that currently established through the engagement in sustainable finance activities. The second is on the reporting framework. As we probably aware, we have GRI. We know about the SASB, Accounting for Sustainability Review framework. We know E-Liability Approach. There are many reporting frameworks proposed by industry and proposed by multi-stakeholders. But lastly, when we talk about the global goals, currently several activities such as supported by the UN and UN Paris Climate Agreement, also the SDG, Sustainable Development Goals, Greenhouse Gas Protocol, etc. There are several terms that we need to also a bit explore later on. First, let's start on this one first. How climate risk transforms into traditional financial risk. Yeah, this slide tries to provide better understanding on the relationship between physical risk and transitional risk of the climate change, its direct impact to the micro and macroeconomic channels, and transmitted to the credit risk, market risk, liquidity risk, and operational risk of entities. Accountant and finance managers, leaders, should be able to better assess this risk because it may lead to the better mitigating its risk from occurrence and prepare of taking necessary action prior to or post of this risk event when it happened effectively and efficiently. Next slide. When we try to explore on the sustainable reporting landscape, these are several terms that I just explained before. The government of the Republic of Indonesia continues to enhance international cooperation to advocate climate actions and to mobilize the private public sector's finance for climate actions. Indonesia is actively involved and continues to show its leadership in leveraging the sustainable finance ecosystem, including at the G20 Forum, ASEAN Coalition, Minister of Finance and Climate Actions, where Indonesia is one of the co-chairs of the coalition currently. The government also continues to enhance cooperation with all key stakeholders such as Green Climate Fund, Global Environment Facility, Adaptation Fund, International Financial Institution, multilateral development banks, and development partners, countries, private sectors, and philanthropic institutions. There is a call actually for the private sector's national multilateral cooperation to better respond on urgent need for the harmonization and the convergence of the development of regulations, guidance and certifications, reporting frameworks, ESG rating providers, as well as international commitment to support the development of better sustainability framework for accountability, reporting, risk management, and governance. Indonesia also view the need for global collaboration in order to create the ecosystem for green industries, including for batteries, electric vehicles, and green global supply chain. We all need to realize the importance of this and start establishing the global value chain for production, trade, and investment for green industries. In the next slide, we will try to explore a bit on the supporting ecosystem needed. The sustainable framework for accountability, reporting, risk management, and governance will promote better support ecosystem for the transition from conventional accounting that focus only on profit and shareholder maximizing bottom line towards sustainability accounting that account for profit, people, planet, as well as its externalities. Carbon accounting is one of the key important elements that support better environmental accounting. In addition, the environmental management, water accounting, waste accounting is also eventually will become increasingly important. Next slides. The implementation of the current regulation in Indonesia. There are the several regulations that currently been established. Sustainability report is already announced to public that contains the economic, financial, social, and environmental performance as the financial service institution, issuers, and public company with regard to its sustainable business activities. They have already been regulated by OJK through POJK 51 2017 and also the SE OJK 16 2021. Their arrangement been established as the guidelines to prepare annual reports and sustainability reports. The sustainability report should be prepared by accommodating international standards such as GRI, CDSB, SISB, CDP, and TCFD. There are several names as well that are following up on the current development of these sustainable activities in the global world. And the next slide. The financial service institution, issuers, and public companies are required to prepare a sustainability report, prepared separately from the annual report or as an integral part of the annual report. It must be submitted to OJK every year, no later than April 30 of the following year. There are at least 9 key information that must be put in the entity's sustainability report. next slide, I would like to touch on more strategic value to the sustainability report. Yeah. The preparation of the sustainability report requires a change in business as usual behavior to the ESG business behavior. The information provided in the sustainability report are very important with regards to the ongoing risk factors, the ESG risk potential impact, the risk mitigation, and how company integrate its ESG risk to its business calculation so that it create better future value for the institution in the long run. In the development stage, the provision still provide flexibility in the submission of the sustainability report. During ASEAN 2023 ASEAN presidency, there is a resolute determination to elevate the energy transition program to the forefront of ASEAN priorities. The aspiration of ASEAN nation to collaboratively embark on the just and affordable energy transition is one of the ultimate goals that simultaneously attain a low carbon economy while simultaneously safeguarding our economic growth and preserving employment opportunities for those impacted. The ASEAN Taxonomy version 2 is an example of how Indonesia and ASEAN members are working to enable the orderly transition and foster sustainable finance implementation. The ASEAN Taxonomy now has been introduced with regard to the coal phase out as an activity which may be classified as a green or amber. The ASEAN Taxonomy serves as the showcase of the good, credible, implementable transition with interoperable taxonomy between the regions, countries, and the next challenge is on the interoperability between ASEAN Taxonomy with others such as EU Taxonomy and also the other countries in order to boost more private involvement globally. With regard to the taxonomy is quite clear. It is a classification system that defines criteria for economic activities that are aligned with the net zero targeting. In the EU, they are targeting 2050 net zero. Indonesia targeting 2060 or earlier. The broader environment goals other than the climate as well. So EU taxonomy allows financial and non-financial companies to share a common definition of the economic activities that can be considered environmentally sustainable. In these slides, I portray the next step. The Indonesia ETM and carbon market mechanism in the context of the sustainable finance. Indonesia urgently need for the reporting standard. I think we also can convey this is also at the global stage here. Why? The standard setter, green certification, HR green provision improvement capacity also quite really important. And Indonesia committed to support with the Sustainable Finance Committee that will be developed to support this process. OJK, BI, and the Ministry of Finance will consider as the key player in it. And the next also government regulation will be released by this year or next year at the latest on sustainable taxonomy for Indonesian context. We have already the model list of ASEAN taxonomy currently, and the national guidelines for sustainable activities categories will eventually support the profession, the business owners, investors, the stakeholders to promote better sustainable finance activities in Indonesia and for the better commitment to support NDC and also to reach the ambitious target to net zero by 2060 or earlier. I'll stop here. Thank you so much, everyone.
Thank you, Pak Adi, for sharing the landscape of Indonesia regulations and policies on sustainable finance and also the strategic value of the sustainability report and carbon accounting. So I guess this is a very, what I want to underline here, Dr. Adi Budiarso, is actually you mentioned about the sustainability report requires the change of business as usual behavior to a business behavior that prioritizes ESG. I think we have a complete view you as a public sector from the Ministry of Finance, from the financial sector regulator, Dr. Adi here mentioning about the needs of the reporting standards and also the need to transition from the high emitting sectors to low carbon economy, to contribute to the low carbon economy, because for instance, here Indonesia has a very ambitious climate target to be achieved in 2030 to comply with the Paris Agreement. And the other side, Professor Karthik earlier also briefed us about what we can contribute to the national, like for example, the Indonesia from the private sector, to help them to really account how much is investment needed and how how big is the emission that we can report. So it actually really aligns between the public sector and the private sector. The vision is the same for us to move from the high emitting countries to the low carbon and more sustainable economy. So thank you so much, Dr. Adi Budiarso and also Professor Karthik. Now we are going to open for the Q&A sessions. I'm seeing here in the chat box, there are so many questions coming in. So the first question is from Mr. Andi Susanto. It's for the e-liability. So first question would be for Professor Karthik. For the e-liabilities, are the valuation methods for e-liabilities the same as inventory valuation methods such as FIFO, LIFO, or average, since the company will import the e-liabilities from various suppliers and distribute it to the customers?
Thank you. That is an excellent question. And the short answer is yes, they can be similar to the inventory methods that are used in financial reporting, but they don't have to be. What's important from the perspective of the way the approach works is, number one, that all emissions of CO2 anywhere in the economy get measured once and only once. So that's principle number one. And principle number two is that all of these emissions that get measured once and only once get allocated to basically products and services. So as long as emissions are measured and they are allocated, then the exact inventory valuation approach that is used really, in some sense, we can leave that to the discretion in the first stage before formal standards are created, to the discretion of different industry organizations or individual companies. Again, the key thing is that there must be a full allocation of all emissions. As long as those two principles are satisfied, I'm less concerned about what the specific valuation method is. It's important that the valuation method, whatever is being used, has some sort of causal logic, right? One of the criticisms of FIFO and LIFO is that they don't always have a causal logic. For the purposes of emissions accounting, and this is where the assurance will come in, and the assurance will be very important, is to ensure that as inventories are getting allocated to, or as sort of emissions associated with inventories are getting allocated to products, then basically that allocation has some sort of legitimate causal basis. So that's, I think, how I would answer that question. So short answer is yes, it can be FIFO, LIFO. Slightly more nuanced answer is it doesn't need to be FIFO, LIFO.
Thank you, Professor Karthik. Now we have the second question. I think this also can be related to your answer previously, that the carbon, the emission reduction must be measured and allocated. So for this is related to the carbon, because here in Indonesia, we're currently exploring what are the carbon finance that we can be tapped. There's a carbon tax, there's also a carbon credit and carbon trading. So the second question would be to Dr. Adi Budiarso. The question from Agus Susanto Panindaichi. Now all parties are increasingly aware and interested in getting involved in carbon trading. What is the minimum area required to participate in carbon trading? Over to you, Pak Adi, to address the question.
All right. Yeah. Thank you. Thank you for the question. From my previous slide, as the government already been released recently with the Omnibus law in tax harmonization, there are actually cap and tax and cap and trade mechanism. Yeah, and the government currently still formalizing the support for the carbon market mechanism. Yeah, OJK will release the regulation quite soon. This is still in the process. So the basic for this is actually the accounting for carbon. When we call it unit carbon, it's actually we name it as part of the surat izin emisi karbon atau surat pengurangan emisi karbon. So the cap is actually every single the process thinking that we currently have is if you release the carbon beyond the cap, that actually you have to pay. Yeah, you have to pay either pay taxes or you must trade. Yeah, you must buy the carbon credit from other. So the unit carbon trading mechanism is the one that has been established recently in the various discussion. So the government is very keen to support this carbon trade mechanism through the carbon market. OJK is the institution that has already been enacted or been approved by the Omnibus law as the regulatory unit that will monitor under Pak Inarno. Yeah. So we're still in the process and we'll hope that it can be released soon. Mbak Lutfi.
Thank you, Pak Adi, for your comprehensive answer. Now, we can go to the next question. As you mentioned earlier, that Indonesia, for the case of Indonesia, we're still preparing the complete framework of the carbon trading. So there's the next question from Vietnam. We have participants from Vietnam asking about, given the lack of common carbon emission index, lack of compulsory requirement for suppliers to measure and disclose the carbon emission of their products, how can the producer can get the e-liability they acquire? Now, this question is for Professor Karthik.
Thank you. So that's an excellent question, and so I think from the perspective of our various pilots, I mentioned earlier that we have in process about 50 conversations with various companies on pilot projects. This has always been an issue. In fact, if you go back to the first company that did the pilot, GT Tire, the project manager at GT, Francois, I remember the first conversation we had with him was, how do I get my suppliers to provide all this information? I'm the only company in the world that's doing this. So we use basically what we call the Willie Sutton rule. Willie Sutton was a famous bank robber. And when he was caught, finally, he was asked, why do you rob banks? And he said, that's because that's where the money is. So when we apply the Willie Sutton rule to carbon, basically what we're saying is that when it comes to trying to calculate the carbon footprint of your company or your products, start with the few things that matter most. So if you were trying to calculate the total carbon emissions in making a standard passenger car tire, there are more than 200 suppliers associated with making a standard passenger car tire. But it turns out that 4 of those suppliers, carbon black, synthetic rubber, natural rubber, and steel cord, account for about 85% of the volume by weight. So that's a great place to start. Instead of starting with 200, start with 4. And those 4 suppliers plus your own direct emissions will give you the first approximation of what is the total emissions with your tire. If you're the only company in the world doing this, certainly relative to your peers, then 85% accuracy over your peers is very good. Now, once all the companies in the world start doing this, then you want to be at 99.99% accuracy. But we're very far away from that. The beauty of the e-liability approach is it operates on what's called a recursive algorithm. Recursion is a principle that was invented in computer science to solve very complex problems by breaking them down into simple problems. Now, you think about it, the problem that e-liability is trying to solve is what is the accurate product level emission for every output in the economy, whether it's this iPhone, whether it's this thermos flask, whether it's this Zoom call. You say, wow, this is such a complex problem. How will you ever solve it? So in computer programming, in mathematical programming, you take a complex problem like that, and you break it down into what's called a subroutine. And that subroutine is designed in a way that successive iterations of solving that subroutine make us better and better each time at solving the bigger problem. And that's how the E-liability approach works. So the first time you run the E-liability approach, maybe you have 20% accuracy. The second time you run the E-liability approach, your suppliers have got a little better information from you, so that becomes 25% accuracy. The third time it might become 50%. As more and more data enters into the system, more suppliers enter into the system, and the quality of the data into those suppliers improves, the accuracy starts improving. So it's that recursion process that makes the system better over time. But the first time you're starting with a pilot, start small and focus on the emissions that really matter. Another way to address this question is to go back to that Hitachi example that I used with the electric transformers. Making electric transformers very complex. It requires thousands of components. But Hitachi focused on just one product, one input, which is copper, because copper accounts for more than half of all of the emissions associated with making an electric transformer. So let's just start with copper, and let's trace the copper value chain all the way back to the copper mine. That already gives you so much insight. And as you do this each iteration, because remember, it's not a one-time exercise. The idea is you're doing this at a batch level continuously. As you do this, each iteration gets better and better and better.
Thank you, Professor Karthik. Now, we're moving to the next question here for Dr. Adi Budiarso. There's a question from Muhammad Indrawan from Research Center for Climate Change, Universitas Indonesia. The question is, private sector is the sleeping giant. How to involve the private sector besides ESG and index or rating? Is there a role of BPDLH in engaging the private sector, and does the investment have to be in carbon, or can it be also a biodiversity? Over to you, Pak Adi, for addressing the question.
Thank you. I think that's a really great question. Yeah, BPDLH is one of the green investment bank for Indonesia, and they are currently act as part of the role of the investment banks, supposedly targeting how then also accommodating funds like from green climate funds, from the multi-stakeholders such as the philanthropists, etc., to support the green activities, adapting, mitigation, and as well as in the central and local level. In the second one is what we currently also trying to promote is the PTSMI country platform, where we are targeting on the huge potential emitters of the carbon, the coal power plant, for example. And then several activities can lay down into several, like in the level or even in the engagement at the central and local government. So your commitment or your raised bar for the committed private sector to support is eventually Indonesia is committed, to support those activities, in not only in the local, national, but also at the global level. So currently we are trying to support the development of the BPDLH is one of the piloting for those kind of green investment banks that we are welcoming furthermore in the more sophisticated way. And we are committed to at least by providing clear guidelines. Recently, we are also committed to support with the committee, and next time Indonesia will also launch the government regulation on taxonomy. Those are activities that can be emphasis on supporting scaling up sustainable investments, meet the investors to the investment target, promote securities for the investors, to protect also private investors from greenwashing, as well as help companies to become more climate friendly, and mitigating the market fragmentation in the industries. So with that, we do believe that when you call it the sleeping giants, as we already commit to NDC, for example, the numbers is really huge. The target fund that government currently provided through budget lately on the budget taking, I think more than the commitment should be invited from the private sectors. So that's why we really back to this topic today. I think the accounting or the framework or the support on providing standard setting body that will eventually provide better guidelines for transparency, for better accounting, better accountability for the activities that directly related or indirectly related with the carbon emission. I think that will be fully encouraged in Indonesia. So after this 2 years, for example, while we are finalizing all the government regulation and its implementation framework, Indonesia ready to piloting for the energy transition and expanding these activities to other sector as well, other than the coal mine or industries, as well as the waste management, the forestry, and all other industries. I think that's the framework, Lutfi and colleague here. Thank you.
Thank you, Pak Adi. So actually, I'm going to take one last question for both, for Professor Karthik and Dr. Adi Budiarso. It is related on how the private and public sectors can contribute to the achievement of the nation target to reduce the emissions. There's a question from Aisa Tri Agustini from UGM. The question is, the first one is there any research on how managers can react to E-liability approaches, since the calculations of carbon emissions requires complex technology and understanding? And on regards to that, what are the mechanisms are in place to ensure transparency in emissions calculation and reporting methods? So the first question for Professor Karthik, and the one about the transparency and the reporting methods for Dr. Adi Budiarso. Over to you.
Yeah. Thank you. Thank you so much. Look, there are two basic reactions, if you must, from managers in the context of e-liability and e-liability information. The first is sort of, the technical challenge associated with getting the data. So as I said in the previous question, if you're, say, manufacturing tires or car doors or iPhones or whatever it might be, the idea of working with your suppliers and getting them to provide you with primary data at the level of individual inputs at the transaction and batch level, that requires a certain degree of technical commitment. It requires sort of basically building the data and information systems that allow for that information to transfer. And that's, I don't want to understate the complexity associated with that. The good news is that, of course, there are numerous software companies like SAP, ERP companies, assurance companies, etc., that are providing products in the e-liability space. The Institute itself is a not-for-profit. We have no commercial stake in any of this, but we want to create a whole ecosystem of enablers to make this happen. And that's the good news there. So that's one level of complexity that managers have to overcome in order to run this e-liability system. The second layer is, I think, even more interesting and probably an even bigger challenge, which is more of the sociological challenge, right? Basically, when you tell managers who are used to making decisions based on cost and quality and timeliness, you say, well, I want you to add a fourth dimension in there. I want you to add the carbon efficiency. So far, you know, when companies talk about carbon efficiency, it's very high level, sort of top-down numbers. It doesn't really affect decarbonization decisions on the ground. If you start holding individual managers to account on their carbon efficiency performance, they really start caring about it. And they say, well, but wait a minute, my bonus is based on my profit numbers, not on my carbon efficiency numbers, but yet you're measuring my carbon efficiency numbers. So that requires a sociological transformation in the way we do this, in the level and degree of our commitment to addressing climate change. Dr. Budiarso spoke earlier about basically in the context of sort of the climate transformation that's necessary to get us to geological net zero. We have to rethink the way businesses go about doing what they do. And that's part of that sociological change that we're talking about. Now, the beauty of the E-liability approach is bottom-up, which is to say that rather than telling companies what to do, rather than telling managers what to do, rather than government determining what is the best policy for the whole economy, it creates the rules of the game. And that's what an accounting system does. It says, these are the metrics by which you will be measured. And then it allows the creative entrepreneurship of individual managers, of individual companies, to figure out what is the best technology, what is the best approach to deliver on those rules. Imagine the difference between watching a soccer match where the rules are set up and the players are free to play as they want, versus watching a soccer match where the referee stands on the field and tells every player, now you kick the ball, now you kick the ball. Who would want to watch that soccer match? Wouldn't be a very interesting soccer match. So the beauty of the E-liability approach is to start with creating the rules of the game and then unleashing the competitive spirit, the creative entrepreneurship of companies and individual managers to actually solve those problems. That's how we need to get at it. But of course, by overcoming some of these technical and these sociological challenges that I've mentioned. So it's not going to be an easy mountain to climb, but it's a mountain that we have learned how to climb in the context of capital markets. The final thing I'll say before I turn it back to you is, again, a huge, huge thank you for the opportunity to speak to all of you. And again, if you're interested in following up with the E-liability approach, then please contact the Institute at info@e-liability.institute. So it's info@e-liability.institute. Mike will probably post the email address in the chat so that everyone can see it. But we'd love to hear from you, especially if you want to ride and drive a pilot in the organization in which you're working from. And thank you very much for the opportunity. Back to you.
Thank you,
Yeah.
Professor Karthik. Now to Dr. Adi Budiarso
Yeah.
to address.
Thank you, Mbak Lutfi. Yeah, for the question, before I answer the question, I also would like to congratulate Prof. Karthik. I think I really enjoyed the lesson from Professor, as well as I also the student of Professor Kaplan, yeah, for activity-based accounting and especially in the sustainable accounting. I would like to answer on the last question for me. I will try to reiterate the importance of the global goals on climate change. Yeah. With regard to SDGs, with regard to the adapting and mitigate the risk associated with climate change, it's really already huge, and we already witness on the apparent events. Yeah, and to answer the question on how to promote transparency and promote better and more sustainable activities, I will answer with two important lessons that we just discussed today. First is on the regulation. Yeah, as we already aware, ISSB, International Sustainability Standard Board, and then CSRD, Corporate Sustainability Reporting Directives, for example, SFDR, Sustainable Finance Directive regulations, now come to the impact that we learned from AU. Yeah, AU already launched the AU regulations on AU taxonomy, and recently in the regional level, ASEAN taxonomy. How about Indonesia? Indonesia is planned to also launch the Indonesian taxonomy. So the taxonomy actually will provide clear regulation, to support more sustainable activities in the business, in our area, in accounting and transparency as well. That will be the guidelines. The second, my important point for answering how to promote transparency and sustainable activities is on reporting frameworks. The reporting frameworks that currently we have is so many, various. Some practitioners are actually voluntarily adopt like E-liabilities, for example, GRI framework, SASB framework, the integrated reporting framework, as well as science-based target framework. And there's so many frameworks. And my last comment on this is actually Indonesia and global is urgently need for reporting standards. So the reporting standards eventually will try to integrate or comprehensively comprehend all of the knowledge that currently been developed and promote better practices and promote support for the industries or individuals that currently already been committed to support sustainable activities to embrace it to all in industry. So the climate change risk is already huge, and the commitment to support to tackle this risk is also should become everybody business. I think that's with that, Lutfi, I will try to also thank you for the opportunity and thank you also for the engagement until this late night. Thanks a lot, everyone.
Thank you. Thank you so much for the two panelists and for the participants. We have a big group of participants tonight, Dr. Adi and Professor Karthik, and all are very engaging. And now, giving back the floor to the MC. Over to you, Mas Putra.
All right. Thank you so much for the fabulous presentation from Professor Karthik, also Dr. Adi, and also thank you for the moderator, Ms. Lutfiana, for giving us a very insightful sharing. Also respected colleagues here from UID and also E-liability. And I would like also thank you to all of you who have participated in our panel discussion this evening. We hope to see you again in our upcoming online events. I hope stay safe, stay healthy and happy, and I wish you a pleasant evening. Thank you very much.
Thank you, everyone.
Thank you,
Thank you, everyone.
Prof. Karthik. Thank you,
Thank you,
Pak Adi.
everyone.
Thank
Thank
you,
you,
Pak
Pak
Cika.
Andri.
Andri, thank you so
Putra,
much.
thank you so
Thank
much, Kang Yoto.
Thank you so
you.
much.
Mbak
Thank you so
Dania,
much.
everyone,
Thank
thank you
you,
so
Thank you,
much.
Mbak Dania. Thank you, everyone.
Thank you, everyone.
Dr.
Bye-bye.
Senyoto, terima kasih banyak.
Thank you, Pak. Thank you, Mas Putra. Wonderful moderator. Wonderful MC.
Thank you, Kang Yoto.
Dedi,
Pak.
thank
Iya,
you,
makasih,
Pak
Pak.
Adi, Budiarso.
Thank you, Pak
Wonderful,
Adi.
wonderful presentation.
Thank you,
Thank you,
Pak.
Pak Putra.
Semoga bermanfaat. Yuk.
Wah, very
Sangat, Pak.
insightful.
Terima kasih Mbak Cika, Kang Yoto, semuanya. Thank you.
Thank you, Mbak Sylvie.
Ya.
Thank you. Thank you ya, izin live. Ini udah mau habis baterai.